Eddie, how's it going?
Hey, doing good. Doing good. It's been probably longer than what we wanted to kind of record this, but kind of back at it, do a market recap, looking ahead and having a good conversation and talking about some important things. So yeah, excited to be here. It's always fun to do these and sometimes kind of get a break from all the other stuff that we actually do day to day and week to week and quarter by quarter. So
Yeah, absolutely. We're recording this on Tuesday, April 25th. Mostly going to talk about first quarter, but kind of everything. It's a balmy 44 degrees here right now. What do you got down there in Orlando?
probably about 80 degrees or something like that. It was
Oh,
actually
life
raining
is hard.
earlier and
Oh,
it's sunny right now, so
we had a mix of rain and snow this morning, so
yeah.
I'm not really
Yeah,
feeling
but
it.
last week or about a week ago, you guys had, 70-degree weather. I remember a couple meetings we had. Everyone's outside that was living in Chicago, so they're living it up for a little bit.
We have to take advantage of the good days when we have them. So awesome.
Yep.
Well, we're gonna maybe have a little bit shorter conversation than we normally have. Just, there's a lot that's going on, but at the same time, I think the overarching theme is this is nothing we haven't seen before, and we want to keep investing. And
Yep.
so we'll talk through some numbers and throw out all sorts of stuff. Happy to talk more in depth with any clients that are interested. So I actually want to start with kind of where are we performance wise year to date, and we're going to actually start with a presentation we put together. We've shared with a few clients that looks through the end of March. And
Hmm.
so looking at the first quarter particularly, and then we'll go from there. So
Good.
I'm going to share my screen, possibly. And here we go. So first things first, this is just looking at asset class returns, different things you can invest in. So on the left, you've got things like tips and municipal bonds, bonds that we have there, core bonds, and overall things were positive. And that's what we would expect. Interest rates are higher. You're earning a little bit of money this year for the first time. Plus, they actually have gone down a little bit, which we'll talk about here in a minute. And so that helps with positive returns on bonds. Interest rates and returns move in opposite directions.
Hmm.
Then we have stocks in the gray. So that's US, it was up 7.5 for the quarter. Small cap stocks were only up 2.7. Biggest difference there, again, that we'll talk about is Silicon Valley Bank and how that kind of wrecked the financial sector, especially for small regional banks. International stocks did great, and emerging markets not quite as good, but still positive. Really, the only thing that didn't do well is real assets, and particularly commodities. Commodities were down for the quarter, but this is nice, especially compared to 2022 when the market was down. There's nothing you could invest in that was up other than cash over time. So it's a nice change of pace as
Yep.
we look at these returns.
For sure. Yep.
So I'm going to jump to a little bit broader view, and then we'll kind of go back to our slides that we have here. So what you're seeing now on the screen, there we go, is looking back to the end of the first quarter last year. So this is looking at various things we can invest in since Q1, the end of Q1 2022. So this is looking just past a year, up to actually yesterday. So 4/24, so April 24th. So a little bit more than a year that we have here. And you can see a couple different asset classes. So I'll just go from top to bottom, from best to worst over the last year. The best has been municipal bonds. That's the MUB, that's the gray line, up 0.3%.
Hmm.
Good for you. Everything else has actually been down. So VT is a total international stock market ETF, and so that's down 6% the last 12 months, basically 13 months. S&P 500 is down almost 9%. VWO is emerging markets. That is down to over 10% for the last 13 months. IWM is not Illuminate Wealth Management, but instead is a small cap stock Russell 2000 index. And so that's down 12. And then the NASDAQ, the tech stocks are down just under 13% for the last 13 months. And so that's a very different story than the previous slide, which is looking over really just the first quarter of this year.
Yep.
Anything that jump out to you? Eddie.
Yeah, no, I think you've arrived in the financial world when you have your own ticker symbol. So if
Mm,
we're able
I
to
love it. Yes,
claim
yes.
that one, that'll be great. So,
Do we
uh,
need to talk to iShares and see if we can get that?
yeah, I think they'll be a little bit tough on that. But no, that's yeah, I look at this and one thing we always say have a long-term view, and there are things where you want to have kind of a surgical analysis and concentration and reviewing things, but I remember if you actually even condense this a little bit more, this is shortly after, and I think we have a chart we'll share a little bit later about the start of the interest rates increasing
Mhm.
and just how the market at that point started going precipitously lower. And the S&P at one time was down 17, 18%. And, the feelings that we all felt when that was happening in that short
Mhm.
term, it's pretty profound because you're like, oh my goodness, like, your portfolio's down and all these sorts of things. And, you know, Buffett says often, or he said, past letters and, various interviews, he says, if you're not prepared to have your investments, whether it's mutual funds or individual investments, and hold it, if it gets down to 50%, you probably shouldn't be investing in the stock market. And, fortunately, we obviously haven't seen that scale of things, but I just think this is the long-term view that we say, hey, we're believers in American ingenuity, we're believers in American commerce. There's obviously international companies that having a well-diversified portfolio, and if a thing to think about, if everyone would have taken all their money out of the stock market or even a percentage out because of the fear of the precipitous drop that wasn't going to stop, you would have missed out on some of the returns over the last, quarter four or even the beginning of quarter one. And there's been some kind of tailoring off here over the last few weeks or so. But it's a volatile game and there is some volatility involved in it. And it's certainly not a straight up and to the right type of move. So it is kind of encouraging to look back, even with recent memory, and saying, okay, there are some negative numbers, but it wasn't as profound as
Right.
17 or 18% like we saw. So,
Yeah, for sure. It could always be worse, and there were times that things are worse. 2022, when you look at a diversified portfolio of stocks and bonds, arguably the worst year ever
yep.
for a diversified portfolio. Not the worst year for stocks, but worst year since I think 1700s for bonds. I mean, that's
Hmm.
about as bad as you can get. It also wasn't that much of a surprise. Maybe the degree, but we talked about over the last year, we talked about even longer than that, interest rates were at an all-time low.
Yep.
There's only one direction they could go, and
Yep.
the Fed was really clear on that. And so you kind of referenced the Fed before, and I'll let you kind of look at this chart and also kind of add your own color to it. But
Sure.
this is a chart just to kind of set this up. This is the Fed funds rate, which is that short-term rate that everyone talks about with the Fed,
Mm.
going back to 1980. So you can see the different levels of where things are. Notice the size of the scale on the right, by the way.
Hmm.
It is not linear here, so there's a big change over time. But you can see the big increase just recently. So talk a little bit more about that.
Yeah. I mean, we got used to, after 2008, a very low interest rate environment, 0%. I mean, that was the great financial crisis, all the mortgage-backed securities, all those things that we saw that were I mean, it was a very kind of scary time when you thought, hey, the whole banking system. At the time, I was in politics, and I remember just kind of, and I didn't work in Washington, but I was at a local office here in Orlando, and I remember just talking to other staffers in Washington and just kind of hearing their conversation and hearing their just the tone of what they were hearing, and no one knew frankly what was happening. And so the obviously the bailout, however you want to call it, that was bipartisan, that came in and really kind of started a really low interest rate environment. And for some time in the beginning of last year, the Fed was very clear that some inflation prints were coming up, and they were starting to say, hey, inflation was going to go higher. And what does that mean? The first interest rate was a quarter basis points, and it continually went up on a very quick scale, as you can see in the chart here. And that had some ramifications. You can see, some of the bank failures recently, Silicon, Signature, and they were long on some of their, investments, and obviously with the rates and all that. So it's interesting how an impacts rates have on everything from an investment standpoint. And to your point, you talked about the differences in bonds now as it was to a year ago. So there's just a lot of factors that interest rates have an impact on. And we've been talking to clients about that. You've been trying to kind of communicate a difference in. It's hard when you tell someone, hey, you kind of communicate something, but something's changed really quickly, and they have someone wrap their mind around that. It's not quick to turn around a lot of times.
For sure. Well, and we have never seen interest rates go up as quickly as we have in the last year. And so even if we plan ahead, there's people whose entire job at Silicon Valley Bank was to plan for risk of what could happen. And, candidly, they didn't do their job very well. But also, if you polled all the experts, nobody expected it to be that fast that things went up. The Fed even at one point last year said they were done, and then within a month they had raised rates again half a point. And so there's a lot that goes into it. We're going to jump in, kind of wrap all this into kind of one story here, throw a whole bunch of charts all at once, and talk through where all these things are interconnected and what does that mean going forward. And that's really the most important part. We talk a lot about what already happened because that's easy. But what's more important, what everyone worries about, is what could happen in the future. And we don't want to fight the last battle. We want to look ahead to where things are going to go. And so that's where we're going to focus kind of the rest of the time. So kind of wrap up where we are, but more importantly, where does this leave us as we go forward? So what I have here, a couple different charts and a nice summary, and we can actually send this. We've got about 8 pages here of different economic slides. I'm not going to walk through all those together on this video, but if you want to look at it, you want to talk about it, let us know. We can schedule some time. But I guess the overall theme is, when we talked about and we shared our outlook at the beginning of the year, it was December, and then in January we resent it out. The number one thing was volatility's here. Volatility just means prices are uncertain and they move around and things change on a daily basis more than normal. Volatility would be driven primarily by the Fed. And that is essentially what's happened. When the Fed speaks, when the Fed meets, stocks move, bond prices move. When there's not a lot happening with the Fed, it's pretty stable overall. And that has been a theme for 2022 and then into 2023 that we have it now. And that will continue as long as the Fed keeps raising rates on the rate that they're in. But there's a lot of information here, the next couple of slides, that would suggest the Fed's almost done. And they are pretty much done if they follow what they've said from the beginning, which is to keep inflation under control. No one wants to see double-digit inflation like we saw part of last year. And so let's start here on the bottom left. So the bottom left is looking at inflation. Again, this data is as of the end of the first quarter, so just 24 days ago. The two lines you have is the dark blue line is the 12-month inflation data. What's actually happened looking back 12 months to prices, up 6%. The flip side is looking just the last 6 months, but then annualizing it. So basically doubling what's happened the last 6 months and say, okay, if we have the next 6 months the same as the last 6, what will the inflation look like then? And that's actually only running at 3.2%. That's the blue here at the bottom left. Okay, why does that matter? What that means is inflation's starting to slow. When that 6-month number is a lot lower than the 12-month number, that means the most recent 6 months are a lot lower price movements than they were before. So that's just on its own, that's a big number that if we're at 3.2%, the Fed is done. The Fed is not going to do anything else once we have stabilized at 2 to 3% inflation rate. So that's number one. Number two, this actually might be even higher than what's happening in reality. And the reason I say that is the number one piece that is still high is what's called owner's equivalent rent. That number is a lagging indicator, and it's just a way to have housing incorporated into CPI, the inflation numbers. Well, that number takes forever to change. And so we have a higher number as a base than what's probably happening. If you just read the news, prices are starting to come down, rents are coming down. We had a major drop in home price last month. I think it was the biggest drop in 11 years in home prices year over year. So you're starting to see in the housing, it's not flowing through yet to CPI, but it might be even lower. So that's kind of number one. And we can also see that looking at the top right. So top right, this is looking at expectations for where the Fed funds rate, the Fed rate, is going to be at the end of this year. So the first place we want to start is the light blue. That light blue is how we started the year. As of December 30th, 2022, what were the expectations looking ahead? So the expectation was we'd end at the 4.75 level. At the end of this year, that's the number we'd be at. Then, as the year went on, looking at March 8th, now this had shifted to 5.75. So the expectation just in the first quarter had jumped up a lot. And that was a lot of what happened early. If you think back a couple months ago, the Fed was raising rates faster than most people expected. And that's reflected here that we had to, nip inflation in the bud and get this down so we don't have a problem. But then between March 8th and March 15th, Silicon Valley Bank collapsed. And we're going to talk about that here in a second. But when Silicon Valley Bank collapsed, now the entire narrative shifted from I'm worried we have high inflation to, oh no, we're going into a recession. And you saw that within a week, the bond market moved and expected that the Fed funds rate would end at 4. So that is a dramatic move down in 1 week. Now we've settled at this dotted line, which is right about what the expectations are today, and that is at a 4.5 level. That is slightly lower than the expectation if you look back at the beginning of the year, but it's still very much in line with where we are in the market, which is the Fed's kind of done. Probably won't change rates all that much. Okay.
Yeah.
Just threw a whole bunch of stuff at you, looked at some charts there. I think it's important to talk about Silicon Valley Bank briefly. If you're not in the tech world, if you're not in Silicon Valley, if you're not really in on all the investors and private equity and venture capitalists, I think it's easy to miss how important SVB, Silicon Valley Bank, was to startups, especially tech startups. SVB was the bank that companies went to, tech companies, to get funding to start their business, to have a lot of the innovations that have come out. And so you have all the tech industry is so tied in with SVB that it was a shock, especially to Twitter, when Silicon Valley Bank didn't have the strength that was expected for the amount of money that they had. And essentially what happened is SVB had bonds that they had invested money into. And just like your portfolio, if you had bonds last year, they lost money. The value of those bonds had dropped 10% if you sold them. Well, that happened to SVB as well, which means if they had an issue that they needed cash, they would have had to sell those bonds and realize this loss that was unrealized up to that point. And as soon as people started to get spooked, it started to run on the bank, where it became a situation where it was irrational to keep money in the bank because you didn't know how long they were going to be there. The Treasury stepped in and said, we're going to make sure all depositors get their money, but SVB went under. Signature Bank had a very similar thing happen, but that led to concerns of a banking crisis similar to 2008. All that being said, although tech companies were hurt and companies that had a lot of money at SVB were in the short term hurt, there never really was a risk of the great financial crisis again. But small regional banks were hit, especially their stocks, and that is part of the underperformance that small cap stocks had in the first quarter compared to large cap stocks. So there definitely was an impact on all of our client portfolios, but it never really was that big of a risk to the whole system. It was just a risk to all the people that are loudest on social media, because those are the tech people that were most directly affected. So some companies were affected, some investors were affected, but for our clients, it doesn't really affect anything about their portfolio or anything else.
Yeah. Well, there's a lot there too. I mean, even that's just one example that sometimes I think information is really good, but it can be very paralyzing. So at one point, Treasury and the FDIC, hey, we're not backstopping all these, unsecured deposits. You have Roku, crazy example that had millions of dollars in unsecured deposits just sitting there. And you have other meaningful business entrepreneurs that, employing people, regular families that probably, unbeknownst to them, didn't realize. So then they eventually came. So one day they're not doing this, the next day they say they do it, and there's a lot of stories reporting, well reasoned reporting that say, hey, there's been some Department of Defense contractors and companies over here that'll be affected, that'll hurt national security. So all this to say, there is just a confluence of information that we can follow some of the leads, but we do know that they ultimately decided to step in because of a perception that there was going to be kind of contagion moving forward. And I think this is important to say there are some controllables that we can control, and there's some uncontrollables we can't control. And when it comes to investing, there is we've gotten to this stage for a purpose. There's individuals, whether it's retirees who are receiving Social Security income, they're drawing some money from their portfolio, they have a different risk assessment, they have a different time horizon, and there is a function of the portfolio that has a duration attached to it. And I think of investing in the stock market as purchasing a house. When you purchase a house, you don't have a means, and you certainly are not checking your property appraiser, seeing what the value is every single day. And we do that a lot of times with, because that is a an asset that has a purpose, that also has a financial value attached to it that affects your net worth. But with the stock market, it's a little different. You have stock prices, you have ETF prices, and you can see that. But the goal is this is a long-term mechanism to help you achieve your goals, your retirement, the kind of life you want to live. For some people, it's gifting. We're actually talking to a client this Friday that's done really well. She's been a physician, and she's kind of gotten to the point where now she's looking at gifting some properties and helping. She has a heart of service, and she wants to give some of this to the community that she has, because it's her way of giving back to her local community, which is excellent. So really having that mindset of what it's about, I think is really key to anchoring you. And I think about what Peter Lynch said. Peter Lynch said that more money has been lost in trying to adjust and protect from a correction than actually a correction. So we make mistakes when we get too emotional. We don't really put these things in the right place. Now, the flip side of that is to say there are some things you got to be careful. We're not saying there is no risk involved in it, but there's some kind of foundational things, and then the market builds on that, and we continue to look at that and rebalance the portfolio. As you mentioned, we did kind of made some adjustments to portfolios last year that was communicated to clients and that sort of stuff. So there's a process, but it's a controlled process and for a purpose, and it's not just something you do. So I think that long-term view is really important to keep in mind.
Yeah, absolutely. And what are you investing for? What is this for? I think it's really important to keep in mind. We Clients that have worked with me for a long time have heard me say you should have nothing in the stock market that you need for cash reasons in the
Hmm.
next 10 years. And the reason for that is if you can just set it and forget it and let it do its job, markets reward the long-term patient investors.
Yep.
And I recently talked to a client about this because compound interest is hard, compounding returns is hard to like grasp. But I said if we can just earn 7% on their money, they're young and they're investing, and we say, okay, even if you don't put any money in, if you earn just 7% for the next decade, your money just by compound interest is going to double in value. So if
Hmm.
you have $1 million invested today and you just let it do its job and earn 7% a year, which is, by the way, lower than the long-term average,
Hmm.
you'll have $2 million 10 years from now.
Hmm.
And That is why we want you to be able to invest and keep money invested and not have it touched, if it's in the stock market. Bonds are actually paying something. Money market funds are actually paying something now. You can buy a 6-month T-bill treasury bond right now that's paying 5%
Yep.
risk free that you're going to get. So there's plenty of options on what to do with your cash or
Yep.
something that you think you need 3 months from now or 3 years from now. That
Yep.
everything else that's in stocks, you can just let it do its job and invest for the long run. If
Yep.
we look ahead for the rest of this year, I think the most important thing that any client can hear is the news will probably get worse, whether it's geopolitical, whether it's recession fears, maybe the Fed raises rates more than we expect, even though I
Hmm.
think all the data is pointing to recession's a bigger problem than the Fed raising rates too fast
Yep.
or inflation. So there'll be something in the news. And every one of those times for a short term investor is the worst time to invest because now you look at the price that changed and you lost some money. But for a long term investor, that is the best news you can have because as you're putting more money in, when you hear news that brings the market down, that gives us opportunities to continue to buy. And
Hmm.
so what you should know is if rates have peaked or are close to peaking and they start to come back down, we will, regardless of the news, be looking to sell some bonds as they go down in interest rates because the price is going up
Hmm.
and reinvest into stocks.
Hmm.
Again, it's only for the money that's going to be in there for 10 years or longer,
Yep.
but that's our plan. And that we want to protect on the downside, and you got plenty of assets to protect on the downside on the way we structure portfolios. But we also don't want to just give up on the upside.
Hmm.
What's the point of investing if you're not trying to make a little bit of money to do it to achieve all those points that you have of why you're actually investing? We want to
Yeah.
protect you on the short term and invest for the long run. And so I'm very optimistic when it comes to investing over the next year because I'm very optimistic about what it means to invest for the next 10 years, 20 years, 30 years.
Yep.
Time in the market is more important than timing the market. The longer you can keep money in the market is more important than knowing exactly when to buy and when to sell. And so we're going to invest, we're going to rebalance. There's a lot of reasons to be optimistic. Fed getting things under control, inflation's not a problem. All of those things are great. But even if they weren't, I'd still say we
Yeah.
want to keep investing.
Absolutely. No, and I think was it Benjamin Graham said, "Hey, in the short term, stock market is a slot machine, and in the long term, it's a weighing machine." And I mean, there certainly, as you mentioned, over the last year, we've seen a lot of change, a lot of uncertainty, a Ukraine war, the inflation, all the things you can think about, just coming out of the pandemic and COVID, and who knows what the future brings. It's the whole thing is, risk is what's left when you thought of everything, and it's the final thing that you can't account for. So we don't know, and you just I I've heard someone say, why are you an optimist? He goes, well, if I'm going to be a pessimist and everything's going to go, the world's going to end, it's not going to matter. There's nothing I'm going to be able to do. It's going to make a difference.
Right.
So I might as well be an optimist. And that's not to say we don't take into account concerns and fears, because those things are very felt and very real. But we do believe, and I mean, there's so many. You actually corrected me on this. I told you once. I said, yeah, I don't know if you're going to remember what I'm going to tell you, but I actually had a friend who's a business owner hired someone, a younger worker, in their early 20s, and he says, I have no idea how this next generation is going to, kind of succeed, because he talked about work ethic and all these things that he saw
Mm-hmm.
in his business. And then you saw, and I think this is important because we hear those things and then we kind of, it becomes a microcosm and we look into them. We don't think about anything else. But you found something, it was a Wall Street Journal article, and you sent it to me, and it talked about how these young entrepreneurs in the same demographic that I told you that my friend said are working hard, they're creating businesses, they're looking to solve problems. So there is a lot of good out there that's happening, and we just got to look a little bit for it. and, kind of focus our spotlight on that. And yeah, long term, we believe that, I believe America is going to be the driver in a lot of things. Yeah, we have a problems. Yeah, we have debt issues. Yeah, we've got, these issues that we're dealing as a nation, political instability, all those things you can talk about, all very real. But if I'm staking my flag anywhere, it's going to be here. And I think I wouldn't bet against America and the American economy and the system that we have. 'Cause I do think, people are going to look back and say, "Hey, I'm glad I was in there." And we'll have to see how the next few months and years adjust.
Right. It's definitely not a set it and forget it. Yes, we're long-term investors, but we do make changes as it makes sense. At the same
Hmm.
time, overall, you want to be invested, and that's the most important part. And you want to be invested in the global economy. And right now, the leader in innovation, the leader in where we're going is America, from a capitalistic perspective. And so we want to, obviously we have more invested there just because of the way market cap and spending US dollars. There's a lot of reasons to be worried, but if you shut off the news and actually look at the data and actually look at what is out there and what the history has shown,
Yep.
there's a lot of reasons to be optimistic. And we're not going to let fear be the driver. We're not going to be ignorant to what could go wrong.
Hmm.
Make very intentional allocations, protect you on the downside. But we are staying invested, and that's what we're here for.
Yep. Yep. For sure.
So with all that, I think we covered a lot, and none of this is, I think, brand new for anybody that's worked with us for any period of time. At the same time, it's good to have these kind of resets every quarter. We will continue to send out monthly market recaps for the first 2 months of every quarter, and then we'll have this video, couple 3-4 weeks after the quarter ends, so we can kind of recap where we are. So the next couple of months, you'll be getting the monthly recaps, and then in July we'll come back with another video. If you've got any questions, reach out. But Eddie and I are always happy to talk about stuff. So Eddie,
Yep.
thanks for
Yeah.
all your insight.
Great to be here. We'll do it again. And as Ben said, let us know if you have any questions.
Sounds good.